It's 2 a.m., and Marcus is staring at a spreadsheet that should make him happy. Revenue doubled this year. Headcount tripled. And somehow, he can't make payroll next week. He did everything right, took the funding, hired fast, scaled aggressively, followed the playbook everyone said would work, and now he's broke. Here's the thing. Marcus isn't alone, but there's another story playing out right now, and it looks completely different. In 2026, something fundamental shifted. The founders who were actually winning, they stopped chasing scale and started chasing something simpler. Profit. Not someday profit. Not investor deck profit. Real money. In the bank. Every single month. And the data backing this shift, it's not subtle. It's a complete reversal of everything we were told about how to build a company. For years, and I mean years, the dominant startup narrative was simple. Grow fast. Burn cash. Worry about profit later. Raise another round. That playbook made sense when interest rates were near zero and investors were throwing money at anything with a pulse in a pitch deck. But capital isn't cheap anymore. And the cautionary tales of overfunded startups that crashed and burned, they're everywhere now. I've watched founders raise millions, build teams of 50, and walk away with nothing. Not because they weren't talented, because they optimized for the wrong metric. Meanwhile, there's a quieter revolution happening. Founders who never took $1 of outside money, building businesses that actually pay them, every month, without permission. Here's the number that stopped me cold. 60% of bootstrap startups reach profitability within 3 years, compared to just 35% of funded ones. 60% versus 35%, that's not a marginal difference. That's a completely different game. And it's not just about survival. Nearly 9 in 10 small businesses, 87.8%, report revenue that's stable or growing as 2026 begins. Let that sink in. Almost 90%. In an economy where everyone's worried about recession and uncertainty, small businesses are quietly thriving. 45% report actual year-over-year revenue growth, not flat, not surviving, growing. And here's what really matters. 78% of small business owners are optimistic about their profitability forecast for 2026. More than 60% of business leaders feel more positive about their own company now than at any point in the past 5 years. So what changed? Why are the bootstrap founders winning while the funded ones struggle? It comes down to one thing: alignment. When you take outside money, your incentives shift. You're not building for profit anymore. You're building for the next round, for the exit, for someone else's timeline. But when you bootstrap, every dollar that comes in is yours to keep or reinvest. Your business exists to serve you, not a cap table. The Founders Daily Analysis put it perfectly. Bootstrap startups emphasize ownership, profitability, and sustainability. Funded startups emphasize speed, scale, and market capture. Neither approach is wrong. But here's what most founders don't realize until it's too late. Those are completely different games with completely different winners. If you want to build a unicorn and swing for the fences, funding might make sense. But if you want financial freedom in a business that actually pays you, the bootstrapped path wins. But here's where it gets tricky. Profitability on paper isn't the same as cash in the bank, and that distinction destroys more businesses than bad products ever will. As one CFO analysis put it, many small business owners confuse profit with cash in the bank. The P&L looks strong, but the checking account tells a different story. And here's the silent killer. Payment collection times have stretched dramatically. What used to take 30 to 45 days now often takes 60 to 90. That gap, 60 to 90 days before you see money you've already earned, is where profitable businesses go to die. Think about it. You deliver a $10,000 project in January. Your client pays in March. But your rent, your team, your software subscriptions, they all want their money now. This is especially brutal for businesses selling to corporate buyers. Enterprise clients with net 90 payment terms can strangle a growing company with their own success. So what's the move? First, and this isn't optional, you might want to start tracking your cash flow weekly, not monthly, weekly. Some experts suggest every 13 weeks rolling. That 13-week window gives you enough runway to see problems coming and actually do something about them before they become emergencies. Second, and this one tends to make the biggest difference, consider setting tighter payment terms up front. Net 15 instead of net 30. Deposits before starting work. New customers especially. You don't know them yet. You haven't built trust. There's nothing wrong with requiring 50% upfront to begin. Now, none of this matters if your costs are eating you alive. And that's the other pressure point. 34% of small businesses say rising supply costs impacted them this past year. Rising costs without rising prices equals shrinking margins. And shrinking margins compounded over months? That's how profitable businesses quietly become unprofitable ones. Here's something most founders resist, but research keeps supporting. Many small businesses undercharge significantly. A 10 to 15% price increase often loses fewer customers than you'd expect. Your loyal customers value what you do. They're not leaving over 10%. And the ones who would? They probably weren't profitable customers anyway. Before any growth investment, any hire, any tool, any marketing spend, you might want to ask yourself one question: will this improve my profitability within 90 days? Not someday. Not maybe. 90 days. If the answer isn't clearly yes, that's probably not the right investment right now. I know this sounds conservative, maybe even limiting, but here's what I've learned watching hundreds of small businesses over the years. The founders who build lasting wealth almost never got there through aggressive scaling. They got there through consistent profitability, compounded over time. The boring path wins. And there's good news on the efficiency front. 80% of small business owners using AI tools reported increased productivity this past year. That's not about replacing humans or chasing trends. It's about doing more with the resources you already have. Working smarter on the margins that actually matter. Here's a framework that tends to help. Calculate what I call your freedom number, the monthly revenue your business needs to pay you, a comfortable salary plus 3 months of reserves. Not your fantasy number, not your ego number, your freedom number, the amount that lets you sleep at night and weather a rough month without panic. Once you know that number, every business decision gets clearer. Does this move get me closer to my freedom number or further away? That's really the only question. Look, I know the hustle culture messaging is loud. Scale or die. Move fast and break things. Grow at all costs. But that advice? It's designed for a game most of us aren't playing and shouldn't want to play. The vast majority of successful business owners, the ones with actual money, actual freedom, actual lives, they didn't build unicorns. They built profitable local businesses that pay them well. A business pulling in $150,000 in annual take-home income to its owner. That's generational wealth territory for most families, and it's completely achievable without ever taking outside funding. No board meetings, no investor updates, no pressure to 10x next year or get replaced. Just a business that works for you instead of the other way around. Now, every situation is different, and you should absolutely run your specific numbers with an accountant or advisor before making major moves. But the pattern in the data is hard to ignore. The businesses that are growing right now, the ones hitting their profitability targets, they're not the ones chasing scale. They're the ones who figured out their numbers first. And that's the signal worth watching in 2026. Not who raised the most money, not who has the biggest team, but who actually built something that pays them. If this kind of practical business strategy resonates with you, consider subscribing. We dig into these signals every week. What's actually working for small businesses, not what venture capitalists want you to believe. So where does this leave us? We're in a moment where the old rules are being rewritten. Growth at all costs is giving way to profit first. And that shift benefits founders who play the long game. Marcus, the guy from the beginning staring at his spreadsheet at 2 a.m., he figured it out eventually, laid off most of his team, focused on his 3 most profitable services, paid himself for the first time in 2 years. He didn't build a unicorn. He built something better, a business that lets him sleep at night. And in 2026, that's what winning actually looks like. I'll see you next week. Until then, keep watching the signals. And remember, this content is for educational purposes, not financial advice. Always consult with a qualified advisor for your specific situation.